Welcome back, everyone, to the Biz Beat by SVA, where we break down tax and business developments that business owners need to know. I'm Lee Schwartz, Director of Business Development and Sales, and joined as always by Eric Trost, Tax Principal and SVA's President. Eric, end of August. Summer got away from us. How you feeling? You ready for this thing to end and go into fall?
No, I'd like summer to keep going for another couple months. So I want to maybe get a golf game or two in yet.
My next golf game will be my first this year, which says a lot about my golf game, but I don't think it's going to happen this year. That'll be my New Year's goal for 2026, more golf.
There you go.
All right, we got a lot of things to cover. Let's jump right in. But real quick, first, always a reminder: if you want information on this big, beautiful bill, head over to sva.com/OBBA. That's OBBBA for our latest updates, biz tips, some recordings of the podcast, all sorts of information that you, as a business owner, need to know so you can plan ahead. Eric, we're not going to touch on too many OBA things today. One of the things I know we want to talk about is, and we've touched on this before, IRS has been talking a lot recently about how they're doing on the staffing front. Can you give our listeners an update on where they're at? And then we'll talk a little bit about maybe the impact that might have.
Yeah, let's talk about that. First, go back to your OBBBA, OBA. I heard a new name for it. OB3.
All right.
So it's kind of like got a Star Wars.
I was wondering if that's like an
like
Obi-Wan type of thing. Okay.
Yeah, this is OB3.
OB3. I think I like it. But
Yeah.
we're not changing the URL. It's still sva.com/OBBA, OBBBA.
Okay. Don't change the URL.
Maybe we'll have a redirect on that too. You can go to either one. Right. That just means Patrick's now has to add more stuff to our website. Forget it. OBBBA. That's where it is.
Very good. So to your question, talking about the IRS and staffing, this is a topic that goes back several years. The IRS at one time lobbied for a lot more agents. Like they wanted 80,000 more workers to come work for them. And at one time there was an allocation under former President Biden in one of his bills, Inflation Reduction Act, to bring in more IRS agents. And that hiring hadn't really started happening yet, as there was some approval mechanisms from Congress that had to happen to release those funds and get that hiring done. It was going to be $80 billion released. That is not happening. And not only is that not happening, it's going the other way. So the IRS, as far as employees go, had about 100,000 employees, let's say a year ago. And there is now 75,000 employees. What the government did is essentially started early retiring or offering early retirement to IRS agents, and also said, hey, if you're on your probation period, which I think is 2 years, there was an evaluation done and you might have been let go from the IRS. So the IRS is down significantly in people. I'd say it's about 25% headcount reduction.
That's pretty significant. What's your sense of what impact that's going to have on audits and how that's going to affect business owners who've maybe gone under audit before or might have gone under audit in the future?
Yeah, so right now I think it means that less manpower means less audits. So to the extent the audit rate was somewhere around 1%, let's say for high wealth individuals or business owners, it's probably going to go down. They just don't have the manpower to do it anymore. But if you do get audited, one of the things that, still got audits going on, they're still going to happen. One of the things that we'd want to do is, I think what's going to happen is these auditors, they work for the government, but I think they're still human. Okay.
Did you say
and so they're
still human?
Yes, that's correct. And so I think what you'd want to do, and we did this before, but now even more so, is I think they're going to feel overworked and, always behind at this point. And so I'm not, calling sympathy for them, but what I think would be helpful is if you are under audit, to really make their job easy And this gives you a chance really to set the narrative for your audit and lay out information for an auditor in a way that's easy to digest, understand, and frankly move on to whatever next thing that is they have to do. So what you're trying to do when this comes up is somewhat really grease the skids for the auditor, make them have an easy job, point things out that maybe you want them to see, and really put together a narrative on how you'd like the audit to go when you respond to them, and make an easy time of it for them. So that if they're getting upset and they're under high stress, you become not that for them. You become an easy audit for them. As opposed to fighting them and saying, we're not going to give you this and we're going to fight you for that. Um, you know, that could have bad repercussions just because personally what they're going through. Maybe they are going to decide that you're the one they're going to take their frustrations out on. So in this case, what I'd say is don't be that one. Be the one that makes their job easy. Like, I like working with this guy. He sets everything up for me. He makes my job easy. I can get this audit done quickly. I can respond to the pressures that I'm getting from my boss to get more work done with less time. So I think if you do that, it might just give you an edge, on things that could have otherwise gone wrong.
Right. So really following the mantra, you catch a lot more flies with honey than you do with vinegar.
That's right. That's right. Now, what they'll also probably do is do more what they call desk audits, where they send letters out. And again, the same thing would apply for that. They send letters out because they might say, hey, let's take a look at this issue. You've got a schedule, you've got a rental property. We need to see your mortgage interest or some such thing. So they might send out letters just to try to confirm things. What they're going to do there is it's a way for the IRS maybe to audit more without using people power. And so try to kind of cast a wide net, send letters out, and see if they can get information back that accomplishes what an auditor otherwise might have accomplished, but do it through a letter form. And again, your response to those, I think, is when someone gets that at their desk, lay everything out for them. Here's a response to your letter. Here's the documentation. Here is it labeled, so that when they read through it, it's a roadmap as to what you want them to see. Chances are, if you give them that good roadmap in a concise, clear manner, they go through that and they're not maybe going to dig around for other things. So you're trying to, again, answer their question, but give them an easy roadmap to reference when you're answering their question.
It's interesting because I would imagine that's probably not a lot of people's first instinct is to make it easy on them. But it makes sense. Eric, I know we talk about this. We get questions about these things all the time too. You're talking about IRS audits and
Yeah.
the audit percentage being around 1% for high net worth individuals, business owners. That might be going down with some of the things you've talked about. But there's other types of audits. Like, what are those other audits that you see business owners going through, and what are the risks with those?
Well, like the IRS that works, for the federal government, states have their auditors too. And so states will send out their auditors, and often what states are looking for, they don't necessarily look as hard at income tax. They kind of follow along with what federal does. But the states all have sales taxes, or most states do. And so what the states look for is sales taxes, and there's a myriad of rules that every state has when it comes to sales taxes and what they exempt and what they allow, depending on that state industry group. And add to that, some cities have sales taxes too. So you have counties and cities with sales taxes. Example, Denver's got like a 5% sales tax, city sales tax. Doesn't apply statewide, just applies in Denver. So different states, city rules apply, and those audits get a little trickier. Their auditor comes out and they're dealing with rules that businesses tend not to spend a lot of time with. They try to get a procedure down and say, what's taxable for sales tax? What's not? Am I paying the proper use tax? So you want to have a procedure in place for the folks that are opening and paying the bills and classifying this right so that it gets done correctly. But the rules are often complex and sometimes gray. And if they don't get it right, what happens is you end up doing the wrong thing consistently over time, which is great and easy to correct. However, it can be expensive. So if you're not paying sales tax or use tax on something you should have been, and it happens over the course of 3 or 4 years, that can really add up. And what the auditors do for these sales tax audits is they tend to pick samples. So they'll look at a sample of transactions from year one, year two, year three, year four, and then they extrapolate out the results of those samples over the whole course of the year. So if they pick a 1 month sample and it's a bad month for you, they extrapolate it out to cover the whole year. So that bad month all of a sudden turned into a bad year. So that selection process can be very tricky, and you want to have something set up so you are giving them the appropriate information, but you comb through it first to make sure they're getting the right information.
So that's another states going after a lot of the sales and use tax. Are there others as well that you see businesses coming under audit for?
Yeah, a little more on the sales tax. I think what's important to know on those is that states are gaining power to tax those that are not in their state. That has to do with Nexus, and we've talked about that on an earlier podcast. But what states have done is they've lobbied, but not necessarily successfully. But they've also won some court cases, and that has been successful. And within those court cases, the courts have moved towards saying, look, we're not an old fashioned economy anymore where factories are in a state and do a lot of business within the state. We're in more of a national economy or an international economy, and goods cross borders all the time. And so if your goods are crossing a border, we should get to tax whoever is delivering or making those goods. And states have really opened the door with that. And there's been some recent court cases that allowed them to do that. So what you're looking at for those state audits is, you want to have some review of what happened and go through this with your, internal accounting people or your accountant, and make sure if you're getting questions from the state or you end up with a state audit that you do some prep work first, and they don't just see raw data that may lead the auditor to the wrong conclusion.
Okay. Anything else you want to touch on before we move on to our next topic?
Yeah, we'll hit real quick on real estate.
Okay.
We do see some real estate audits, and I'll give Wisconsin as an example. Wisconsin allows a exemption for manufacturing property. And what's manufacturing property? And within the real estate, sometimes you have a manufacturing real estate property, sometimes you don't. The state often comes out, and their audit is to make sure that if you're claiming an exemption for a property because it's a manufacturing property, that you're truly doing manufacturing at the facility you're claiming the exemption for. And that's where you want to have someone internally or some help from your CPA to walk around and say, okay, I'm claiming a real estate exemption here. I want to make sure that I'm really exempt. Is this a manufacturing property? Because eventually, I think a state like Wisconsin, they have an auditor on their payroll that goes around and eventually hits all of these.
Is that right? Okay. That's interesting. Anything, I guess, I don't know. This might be a longer answer than we needed in the podcast, but I'm curious, like, what are those differences between if you're like, what are those things you'd look for that would say, oh, you're not really manufacturing, but you say you are? Like, what? I'm just curious what some of those things that people might be trying to claim that are really not claimable.
Well, manufacturing has a looser definition than you might think. A lot of people think manufacturing, you're pouring molten metal into something
Right.
and banging it out and, creating something that way. But manufacturing essentially is, changing an object enough that constitutes, believe it or not, within the definition, they say that constitutes a process commonly known as manufacturing. So they use their
They
own
reference
term.
itself. Yeah.
Yeah, it references itself. Now, this is not a Wisconsin manufacturing case. There's a case though that under some old laws under federal where there was a manufacturing deduction where a company that essentially boxed up gift baskets said they were manufacturing. And so they really tried to stretch the rule to say that, look, I'm taking a box, I'm putting the insert in it. They didn't make the box or the insert, but they had to put the insert into the box. And then they put various things that came in bulk, like fruit or cheeses or sausages, and they put them in the different inserts. And they got that to be manufacturing. So it was interesting case out of California. So what you're looking for is, maybe not necessarily just what you think of as manufacturing in a traditional sense, but are you manufacturing within the definitional sense of the tax law? Another example is, what if you're ripening fruit in a room? Is that manufacturing? And there's old case on that, yeah, fruit ripening is a manufacturing process. So you've got a couple of cases out there that really try to expand what you think of might be labeled as manufacturing.
All right. Well, based on the amount of rotten fruit I throw out at home, I'm going to start claiming my home as a manufacturing facility. That's what I heard you say. So
Pretty much, you've got it. You're exempt from the real estate
okay,
taxes
good.
then.
And that's going to be a reminder of the caveat I always say at the end, which is this is not official advice, but we'll get to that later. So, Eric, let's talk a little bit about interest rates. I mean, Trump's always talking about interest rates. We know that the Fed chair is going to be turning over Jerome Powell in the spring or early summer of next year. There's been a lot of talk around that. Can you give us an update on kind of where you think that's heading and what business owners should be thinking about?
Yeah. So the latest news out there, and there's some mixed news on this. The latest news is that the market is pricing in a 25 basis point cut, so 0.25% cut in interest rates, which would be pretty big. They have not had a cut in quite some time. Now, Trump, who's not been a big fan of Powell on Truth Social, has called him out, basically saying it's time to cut these rates. So, from a political pressure standpoint, I got to say it's not subtle. It's being put on very direct that Trump's in favor of cutting these interest rates. I think the market believes they will be cut, but it is somewhat mixed bag, because if there's any inflation out there, the Fed is hesitant to cut rates going into inflation. And part of the cause of that inflation might be, are these tariff inflations kicking in? So we've got the tariffs, and we've been talking a lot about that, and some countries are settling, and most of these countries are settling at tariff rates that are higher than they used to be. Without question, this is a new dawn of tariffs. Tariff revenue has been skyrocketing, up 5-6 times from normal tariff revenue. So that money's coming from somewhere. It's coming from the increased price of goods. Is that leading to inflation that causes the Fed to not make the interest rate cut? So I don't think what's going to happen is rates will go up, but in September, so September 17th is right after their Fed meeting, they come out with the secret briefcase and open it up and read the new rate. And is it up, or is it down, or does it stay the same? I think it's all pointing towards there's going to be a 25 basis point cut, but I would not necessarily bet heavy on that either. It could end up staying the same in spite of the direct political pressure I think that's being put on right now.
Yeah. So if you're a business owner looking to make a big investment coming up, maybe build a new location or expand, what I'm hearing you say is it's more likely that rates are going down in the near term than they are going up.
I think that's right. And actually, we were just talking to a client today about refinancing, and maybe they want to wait another month till after this announcement is made. They could, a quarter point can make a difference on a large debt.
For sure. Okay. Thanks for that. We will, as that meeting passes and there are pronouncements, we will certainly be talking about that as well. But let's move on to the inbox. As always, please send us your questions at bizbeat@sba.com or on our website at sba.com/bizbeat. So, Eric, this week's question, it goes back to a topic we talked about a few weeks ago, um, regarding no tax on tips. How does someone who's self-employed handle that?
Yeah, that's a good question. So, what they're getting to here, no tax on tips, as a reminder, is that those that are in tipped businesses, and think, easy restaurants, beauty salons, that sort of thing, but there's others, those that are in traditionally tipped businesses, there's allowed a deduction of up to $25,000 for your tips. Now, it phases out if you make too much money, over 150,000 single, 300,000 married. But you're allowed this deduction for your tips, and it's going to be what's called an above the line deduction. which means that you don't have to itemize your deductions when you do this. So you basically subtract it from your income before calculating your tax liability. The amount you can subtract is the amount of your tips, but up to, limited to, $25,000. So there's some guidance from the IRS around the law that's pretty clear that, it's going to be look at your W-2, and if tips are reported separately, you do this. And they're coming out with other guidance. So what to do if tips aren't reported separately, how to estimate your tips if, this law is in place for the full year. It's in place for all of 2025. Well, no one knew this was necessarily going to be there. This might not have been tracked. So there's going to be some kind of guidance on how you estimate what your tips were for the first part of the year if it's not separately stated somewhere. This question comes up in the light of, hey, I'm not getting a W-2 because I'm self-employed. Self-employed persons don't get W-2s. They take in income, and they essentially have to pay tax on that income and figure out their own withholdings and pay those in quarterly. And the question here is, well, how am I deducting this if I'm self-employed? I don't have like a W-2 or any reporting system, and do I get to deduct it at all? The answer is yes, you do get to deduct these tips as a self-employed individual, and there's going to be a place for it on the tax form somewhere in order to do this. So as a self-employed individual that's getting tips, let's say you're self-employed in a beauty salon, you would still get this deduction for tips, even though you're not an employee. The guidance that has to come out is just exactly how this is going to be deducted and where to report it. But this all should be reportable for the 2025 year when you do your taxes starting next year.
Okay. So as you were talking about that, I was thinking like, well, a wait staff is not going to be self-employed. And you talked about it like a good example being somebody who works in a salon. No, that person might rent their space and not really be an employee of the salon, right?
Yeah, that's right. I think that's a little more common setup in some of these salons is that beauticians might rent their space and be self-employed within that and pay the rent to whoever owns the building
Well,
or owns the beauty
if
shop.
I know your calendar well, I think Thursdays are your mani-pedi day, right? So you can just ask them tomorrow if that's how it operates or not. We can maybe have an update next week.
That's right. Actually, they won't touch my toes anymore for some reason.
I don't blame them. Okay, well, that is definitely a wrap, everybody, on this week's BizBeat by SVA. Just a reminder, don't forget to visit sva.com/OBA, 3Bs, for resources on the One Big Beautiful Bill. And if your business group or your organization would like a presentation on what's changing, reach out. We're doing that all around. Happy to do that for your group as well. Please subscribe on Apple Podcasts, Spotify, or on YouTube, and share this with another business owner that you think would find it helpful. And as I said, here's my caveat. We're just talking general strategy here. So for your specific situation, always contact your advisor. If you don't have an advisor, that's why we're here. So reach out to me and we'll talk about how to make you a client. Thanks again for joining us today. Have a great week, and we will see you next week on the BizBeat by SVA.
From tax tips to business trends, smart insights from trusted friends. The BizBeat by SVA.